This week, we're seeing two very big companies go public. DoorDash, which is responsible for bringing us chicken fingers and other sustenance to our doors, and Airbnb, providing us with a getaway when our homes get boring. But wait a second, what exactly does it mean to go public? And what motivates a company to go through with it? Well, generally, an initial public offering, or IPO, means a company is ready to offer shares of their company to the public, previously only available to private investors like venture capitalists, friends and family, or employees. Now the public, people like you and me, would be able to buy and sell shares freely. So when does a company decide it's time to go public? First of all, the company has to meet some standards laid out by regulatory bodies. For example, the company has to have predictable and consistent revenue, room for growth, manageable debt, and it should be a pretty strong player relative to its competitors. Now, if these qualifications and more can be checked off, then the company will likely go public to raise extra capital. That's new money it can use to grow operations, hire talent, acquire other companies, that sort of thing. When a company has an IPO, it's issuing new shares at a certain price, and investors pay to own those shares. For example, in 2019, plant-based company Beyond Meat offered nearly 9.6 million shares at $25 apiece, and as a result, raised $240 million. That's traditionally how it works. But these last couple years, we've seen the rise of non-traditional ways to go public, like the direct listing and the SPAC. Let's talk about that second one, because you might have heard of it for the first time recently. Now, companies like Virgin Galactic and DraftKings went public this way. SPAC stands for Special Purpose Acquisition Company and is literally a company that doesn't have its own operations, but instead is created to acquire other companies. SPACs are usually formed by experienced investors who raise capital through an IPO and identify a target company like Virgin Galactic to acquire with this new money. Among the reasons as to why a company may choose to go public via SPAC, the process is faster under the guidance of an experienced partner, and there are generally fewer regulatory hurdles to jump over. There are a ton of other nuances around SPACs, but they're kind of boring. Regardless of the means to go public, there's plenty of opportunity to invest in companies that excite you. For example, lots of new, younger investors have turned to trading platform Robinhood, and the company is reportedly in talks with banks to get the process started for a potential IPO of its own in 2021. So pretty soon, you could be buying shares of Robinhood on Robinhood while you eat the chicken fingers you bought on DoorDash, of which you bought shares via Robinhood. Exciting times. I'm Nora Ali, and this has been your definitive-ish guide. We'll see you next time.